Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning, November 18th, 10 days away from Thanksgiving. You may have read this will be the shortest holiday shopping season that is possible because Thanksgiving falls in late November. And that has caused some concern for some of the traditional retailers, less time for people to actually go to physical stores, perhaps do some more online shopping. So as we approach year-end, I want to emphasize a few different additional points that we've touched on in the past. Number one, to think about year-end tax loss selling or recognizing gains, but strategizing for optimal tax strategy as we approach year-end. Something you want to think about if you own less liquid investments, perhaps individual bonds that sometimes can be less liquid. You want to think about tax loss selling before the masses do. The same would apply if you own equities that are down for the year in a year where we have significant price appreciation. Lots of different market participants may be selling the same securities as we approach year-end. You may want to get out in front of that. Also, keep in mind required minimum distributions. If you're 70 and a half or older, you need to take an RMD in most cases, required minimum distribution. There are a handful of exceptions. But if you need to take required minimum distribution, you want to not wait until the last minute. You want to strategize, and you want to be able to plan on what you should be doing to create liquidity to take that required minimum distribution. There are penalties for not taking your RMD by January 1 of the following year. Also, if you are a participant in a retirement plan, or perhaps you don't have a retirement plan, there are still opportunities to open a retirement plan by year-end, but more likely the scenario is you currently are invested or have an opportunity to invest in a retirement plan. You want to see where you stand relative to eligible contributions for the year, and perhaps depending on your employer and your situation, you may be able to accelerate contributions going into year-end in order to take advantage of some of the tax benefits as we approach year-end. Other strategies to think about as we approach year-end are whether or not you should be bunching together charitable contributions, given the tax changes and the increase in the standard deduction. Many times, for some market participants, it may make sense to bunch retirement contributions in order to exceed the standard deduction in some years, and to withhold from making charitable contributions in other years when you're not bunching those contributions together. Another strategy to consider going into year-end. All right, this morning I'm going to talk a little bit about how to speak more confidently and persuasively. Then going to talk about financial markets. Barron's ran a good edition talking about one of the most complex challenges in investing, and that is not necessarily investing, but in divesting and how to manage your divestiture, or how to manage your cash flow in retirement. And then turn things over to Brad to talk about one of the products that certainly helps that cash flow, and talk about the fixed income markets and any other thoughts that he has this morning. So speaking about how to speak and possibly how to be more persuasive, we've all heard, and this article I'm discussing rings true to the common refrain, it's not what you say, it's how you say it. And new research suggests a little bit more clarity into that. If you're trying to be persuasive, the volume of our words, when vocalized, can have an outside impact. Now, that doesn't mean that you should shout to be more persuasive, but what you should do to become more persuasive is to speak slightly louder than normal, and to vary your volume of your voice when you're speaking, so you're not monotone. Studies indicate that will make you appear more confident when you speak. It also has a positive impact on your overall persuasiveness. Every time we interact with someone, we're trying to figure out how much they know about what they're saying. How believable are they? How knowledgeable are they? How confident do they seem to us? And we have biological sensors that we may be subconsciously accessing, and these cues are particularly important. Volume made speakers more confident, studies show, which made them seem more persuasive overall. Studies also indicate, and perhaps you've seen this yourself and recognize it within yourself, that humans have something of a built-in anti-persuasion radar, something psychologists called reactance. When someone tries to persuade us, we oftentimes naturally push back because we have a mechanism with us that says we don't want to be persuaded. We can tell from the words being used, the context, and other cues that someone is trying to influence us. And that incoming appeal, when someone's trying to persuade us, is almost like an incoming missile or projectile, and we set up defenses to knock that missile down. We may walk out of the auto dealership. We may hang up on a salesperson on the telephone. We may turn off the television subconsciously because we don't like the ad. We may come up with counter-arguments, even though we don't necessarily have a problem with the product, but we do have a problem with the attempt to persuade us. Now, it's interesting to note that a lot of times before we are trying to persuade someone, a spouse, a friend, someone in a business transaction, that we spend a lot of time, many times, thinking about what we're going to say. And perhaps that time would be better spent not focusing so much on what we are going to say, but if we were to focus on how we're going to say it, because sometimes what is heard is not the words, but it is the tone, the inflection, and the way that something is said. Also, in this day and age of the internet, of social media, very interesting that studies continue to demonstrate, and this one on voice inflection further reinforces this, that being physically present has an enormous impact on persuasion. There's work that shows that people seem more human when we hear their voice, and it can make people more persuasive. And that may be good news for anyone out there who has spent hours agonizing over the wording of an email or what to post on social media in order to get it just right, to get it perfect. Something significant is hanging in the balance, and we spend hours agonizing over how to make that presentation through electronic means. And all that time spent agonizing, studies suggest, may in fact be making things worse. At some point, we need to remind ourselves that any changes we make to a creation, like an email or a social media post, no longer make it better. It just makes it different. And studies show that there is a significant diminishing return on the amount of time spent trying to get an email perfect or trying to get that post perfect relative to the benefit that we get. But what we do find in these studies is that effort to create that perfect email in order to persuade someone could be accomplished a lot more simply and perhaps more quickly by using our voice and connecting with the person that we're trying to influence through a personal voice interaction rather than through that electronic connection. So, gonna go back here to the financial markets. Last week we saw the Dow make it to 30,000, and Barron's talked about the market strength last week, where we saw markets rise to record highs again. And once again, this was against a backdrop of domestic political fights, global geopolitical tensions. It almost appears as if the equity market resides in a separate universe. Doug Cass, who runs Seabreeze Partners and has been bearish for some time, said in some frustration last week that seems to be some outside force at work that continues to lift stocks higher. Barron saying that last week as the Dow topped 28,000, talk of 30,000 didn't seem so fanciful, as when Barron suggested it could be a possibility in January of 2017 when President Trump was being inaugurated and the markets were at 20,000. Now, even as the House of Representatives is holding impeachment hearings, stocks continue their ascent unimpeded. The clearest explanation seems to be that while the Democrats control the House and very likely will vote on articles of impeachment, it is very likely, some say certain, that the Republican-controlled Senate would not find President Trump guilty, and therefore, while there's a lot of theater going on, the overall effect will be very minimal. The beginning of last week, perhaps similar to this week, more setup we have this morning, which I'll talk about, we had President Trump speaking at the Economic Club of New York. Then we had the Federal Reserve Chairman Jerome Powell testifying before Congress. Neither of those two moves had moved the market through Wednesday of last week. In fact, the Dow averaged a daily percentage change of just 0.08% over the 5 days prior to last Thursday, when the markets resumed their rise going into the end of last week. And we saw markets last week up anywhere between 0.8% and 1.25% here in the United States. Foreign markets relatively unchanged, and those factors have contributed to financial markets for the year. The S&P is now up over 26% year-to-date. Dow is up 22.5%. NASDAQ up almost 30% year-to-date. International markets up about 18% year-to-date, and emerging markets up about 11%. Also of note, if you're looking at 10-year Treasury bonds, even after the sell-off in Treasuries, 10-year Treasuries are up over 9% year-to-date. Munis up over 6% year-to-date. So we have global markets moving in tandem to the upside. Taking a look at the financial markets this morning, I am seeing futures giving back lots of the gains that I was seeing just a few minutes ago. Not sure what is driving the reversal. Maybe something to do with trade, but not sure. But just taking here, let me just get an update on pre-markets. Earlier we had seen pre-markets on the Dow up about 80 points. Now they're down about 16. So again, relatively unchanged, but not as positive as we were seeing initially. Initially, we were seeing the trade above fair value after Chinese state media reiterated comments made by U.S. officials that Phase 1 talks have been constructive. On a related note, the People's Bank of China surprisingly cut its 7-day repurchase rate to 2.5% from 2.55%, just a 5 basis point cut, but notable since it was the first cut since 2015. Back on the home front, we see continued strength in Apple. Talk that the iPhone 11 is, Bloomberg reporting the iPhone 11 is seeing early success in China. Taking a look at the Treasury market right now, we are seeing yields slightly lower. So bonds have reversed. Yields were up this morning. Now yields are down. 2-year notes at 160. Just a few minutes ago, we were at 163. The 10 years at a 230. The 10 years at a 182. Excuse me. The 30-year is at a 230 in the Treasury market this morning. Just going to check these futures one more time. Not really moving any further. In Europe, we're seeing modest weakness in the DAX and the CAC in France, and the FTSE modestly higher. FTSE higher after reports that Boris Johnson is talking about a billion-pound stimulus package in Great Britain to create tax breaks to attract business to the UK on concerns about Brexit. Another concern market's been focusing on is further intensification of the clashes in Hong Kong. We saw the first mainland Chinese troops make an appearance in Hong Kong over the weekend, and there is ongoing clash between the Hong Kong police and students at the Hong Kong University in downtown Hong Kong. Pete Buttigieg surging to the top of the Democratic candidates list in Iowa, according to the Des Moines Register. President Trump out saying, tweeting that U.S. farmers will receive another major round of cash, and we have a affirmation of the bond credit rating in Italy at BBB with a stable trend. Other news to focus on today is Huawei, the Chinese technology company. The license that the U.S. had extended for Huawei, a 90-day extension. The U.S. had extended in the discussions with the Chinese in trade talks, is set to expire today. The expectation is the U.S. will grant another 90-day extension, but I have not seen any confirmation on whether or not that will or will not take place, something markets will be focused on. Also reports that the Saudi Arabian oil company, Aramco, is going to set the price of their IPO at $1.7 trillion. They were seeking $2 trillion, but you may remember last week we had discussed on the call that Barron's was suggesting 1.5 to 1.7 trillion was what they were expecting, so pricing on the higher end of the Barron's expectation. If that price does in fact represent the offering, that would mean the yield on that on the Aramco would be just under 5%. And that's the dividend yield for the stock that would be trading. Ford in the news. Over the weekend, Ford released video of a big bet that they're making on electric vehicles, and they've even attached the iconic Mustang name to their new electric vehicle. This is a high-profile move by Ford into the electronic vehicle space. The video showed a SUV that looks somewhat like and has some of the design features of a Mustang, a very smart-looking vehicle. So markets will be focused on what Ford's plans are with their electric vehicles. They said that they're looking to roll the vehicle out in late 2020. Perhaps that could invigorate some life back into Ford, which has been seen as a laggard when it comes to innovation in the automotive space. AMD in the news today, Advanced Micro Devices, Cowen raising their target to 47 from 40, and BMO cutting their price target on Twitter from 40 to 33. Looking forward to what's going on this week. Tomorrow we get some earnings from Home Depot and TJ Maxx. Oracle is holding their annual meeting tomorrow. Qualcomm holding an analyst meeting. Also tomorrow we get reports for residential construction for October. Looking for 1.39 million building permits, 1.32 million housing starts, both up modestly if that were to happen. Wednesday we get earnings from Lowe's and L Brands. Salesforce holding its annual investor meeting, also getting the Federal Open Market Committee releasing its minutes from its previous monetary policy meeting at the end of October. And then on Friday, we get the Purchasing Managers Index for November. Economists forecast 51.9 up from 50.9. Expansion is at 50. So moving on to Barron's, I mentioned some interesting articles on retirement strategies, and Barron's headline article cover story entitled "Retirement Savers Are Turning to Dividend Stocks for Income. Here is how to use them in your portfolio." Barron's discussing that with the low interest rate environment we're in, people living longer, that dividend stocks are increasingly becoming a potential component to portfolios of individual investors, saying the once sleepy world of dividend investing is hot. With their attractive income and yields, dividend stocks not only offer solid returns in an era of ultra-low bond yields that doesn't appear to be ending soon, but also holds the promise of price appreciation. Dividends also offer a number of other advantages beyond income, and one of that is qualified dividend income. So even if you're in the highest tax bracket, meaning you're earning over $400,000 in a married household, and you're paying taxes, the tax rate on dividends is 23.8%, significantly lower than perhaps your tax rate if you were to own something like a taxable bond. Retirees' need for dividend income or any income of any sort has become particularly acute over the past 30 years as companies have turned away from offering pensions that guarantee workers steady payouts during their retirements. Now a growing number of investors are seizing on dividend stocks as a cornerstone of their retirement income. And if you're doing that, there are two schools of thought. One is the total return approach, where investors focus on the growth portion of their portfolio and basically take a systematic withdrawal out of their account. That is a more holistic view. The second view is to take what is known as the pure income approach, where investors incorporate dividend stocks and often an allocation to bonds to damp stock volatility. And what it basically entails is an individual living off the income and hoping for some modest appreciation in the dividend-paying stocks that are in their portfolio. Important to note, then different than bonds, if a bond doesn't pay its stated coupon, that bond is in default. That company is in bankruptcy in all probability. With a stock, dividends aren't guaranteed. Companies strive to make dividends payments once they're initiated, but they can be cut at any time when the company feels that there is a situation that is stressful. You take an example of one of the perennial dividend payers, General Electric, a dividend stalwart, and their dividend just a number of years ago was $1.24 annually per share, and now it's 4 cents per share, and that was considered one of the strongest, most stable U.S. companies. So certainly there is risk when investing in dividend-paying stocks, and you have to be mindful of the situation. It's more fluid than with a bond, not that bonds don't need to be monitored, and diversification is critically important. Barron's did mention a number of dividend-paying stocks in this article. I'll mention the ones that have dividend yields over 3%, but certainly can send this article out to anyone who's interested. Key Bank, Key Corp, KEY, dividend yield of 3.9%. Cisco Systems, after the sell-off after their earnings, CSCO, now yielding 3.1%. Prudential, mentioned in this article, PRU is the symbol, 4.3%, and one that we've talked about before, AT&T, symbol T, Telephone, with a 5.2% dividend yield for that stock. Now, speaking about dividends, longevity, retirement, Barron, sticking with that theme, had an interview with Nobel-winning economist William Sharpe, who has spent most of his career thinking about risk. He's behind the capital asset pricing model, and he's also behind the eponymous Sharpe ratio, which captures risk-adjusted returns. A few decades ago, Mr. Sharpe turns attention to what may be the biggest risk for most Americans, and that is running out of money in retirement. And what he did, and he is a professor emeritus at Stanford University Graduate School of Business, he created a computer program that covered 100,000 different retirement income scenarios based on different combinations of lifespan and investment returns, and that program is available in a free book called Retirement Income Scenario Matrices. And what Mr. Sharpe said is knowing how to strike a balance between having enough income to meet your current needs and wants, and having enough to get you through your lifetime is one of the most challenging events that any investor will encounter. And he said there's no easy answer between striking that balance between your current needs and making sure you have enough for your lifetime, though he has a few ideas for how retirees can manage risk better. He calls this problem the nastiest, hardest problem in finance, and he does encourage individuals who are entering retirement to speak to someone that is a financial professional, at the very least, just to be a soundboard or a second opinion, but in many cases, for those who are not equipped to undergo this analysis, to work with a financial advisor to help them manage the retirement income problem. In fact, he finds the management of the disbursement of funds to be the area of growth where financial advisors perhaps can add the most value, not interestingly, not the building of the portfolio, but actually the disbursements from the portfolio. He talks about the fact that creating this sustainable retirement income is such a hard problem because there are two big sources of uncertainty, and you can diminish one but not the other. If you invest your money in almost anything except an annuity with a cost of living adjustment, you're going to be subject to two kinds of uncertainty: investment uncertainty and mortality uncertainty. And if you think about it, he points out how complex this is. If it's a husband and wife, there are so many permutations on the lifespan of those two individuals, even once they hit 65. If you think about it, each person can pass away anywhere between 65 and 95. People could even live longer. But just sticking to 65 and 95, there are 900 permutations on how long those two individuals will live. 30 years for the male, 30 years for the female. in looking at that scenario. So what does he suggest in order to help manage this process? Interestingly, he says that one way of perhaps offsetting some of this longevity risk, and he doesn't suggest putting all your funds into something like this, but he says an annuity is a way to spread the risk of longevity. I don't know how long I'm going to live, he says. You don't know how long you're going to live, and annuities are a vehicle for pooling that risk. He thinks that ultimately that investment professionals who have knowledge of both annuities and investments will become great resources of the future. He also thinks that robo-advisors will start building products that combine annuities with traditional investments in a unified product. Now, speaking of annuities, it's interesting to note that some people like Mr. Sharp have been advocating for annuities and for more annuity investments at a reasonable cost. But it's been difficult to achieve, as you may think. Companies perhaps should or could be offering annuities within their retirement plans and setting up alternatives to just purely investment-based performance, especially because annuities can often look fairly similar to what used to look like traditional pension plans, where there's a guaranteed payout over time. And the reason that there's not more of these products, and actually there's almost none of these products in traditional 401k or retirement planning products, is that under current law, plan sponsors have a fiduciary responsibility to ensure the health of annuities and potentially be on the hook if the annuity provider can't make payments. Now, there's a bill that's currently winding its way through Congress called the Secure Act of 2019, which passed the House earlier this year but hasn't been voted on in the Senate, which would shift that responsibility from employers to state insurance regulators, and that would probably open the doors for companies to add in-plan annuity features, something to be mindful of. Now, just shifting over to the bond market, I'm going to turn things over to Brad. Before I do that, just mention one other article in Barron's. One of the comments that the Federal Reserve Chairman Powell made last week that did not garner huge headlines, but is significant, is that Chairman Powell said one possible change the Fed may make would be to measure average inflation over a longer period of time to determine how far the economy is from achieving its longer-term 2% goal for inflation. That practice would encourage the Fed to keep rates lower during expansions like we're in now to make up for inflation shortfalls during and after recessions. This is something the market took away. Could mean a longer period of low interest rates and could be further justification for keeping rates low longer. Also, some could conversely say that that's something that could stoke inflation down the line. So it'll be interesting to see if there is any significant change at the Fed as a result of some of that commentary. Going to turn it over to Brad, talk some more about the markets. Good morning, Brad.
Morning, Keith. Thanks. Morning, everybody. Hope everyone had a great weekend. Just an interesting comment. In the last couple of weeks, I've probably had more individuals inquire about municipal bonds than I've had in the last 2 years. I think that the sell-off in the bond market has a little bit to do with it, that there's slightly higher rates. I think the other thing that's starting to happen is, this is just my opinion, obviously, a lot of people have made a lot of money here, and they don't know when it's time to get off this merry-go-round. So I do think that people want to protect themselves, they want to protect their profits, and they are inquiring about municipals in a very big way, and I'm feeling it, and I'm seeing it in the market movement in the secondary market. The street are buying bonds. It's just something to keep in mind. I'm not saying it's the right thing or the wrong thing, but it seems to have percolated a little bit here. The other side of the story, because every story has two sides or three. When I tell the people what the rates are, the reaction is ugh. So they're not thrilled with the option of municipal bonds because the rates still are pretty low. And then I will usually go into my story about the kicker type bonds, the 3% plus coupons with the relatively short calls, and I appreciate why I have told you because I put a lot of people to sleep with it, and this is my business. So I understand this, but it is the most practical way to get into this municipal bond market because, in my opinion, we have to play defense here. We don't know where we're going. We've had a big run in bonds. We've had a big run in stocks, and you just want to be a little careful. As for what Keith talked about earlier with tax loss selling, I would suggest that you look at your Puerto Rico bonds that have had a big run off the lows. Some of those bonds have quadrupled off their lows, and you may want to think about taking those off the table. You may have some Illinois bonds in your portfolios. The Illinois bonds have had a little bit of a run here, and nothing has changed in Illinois. You still have the major pension problems, and as we head into the next year, you may also have politics, and the potential political future could be to hell with the bondholder, the way they sort of did it in Puerto Rico. So I would just be careful about what you're buying. I'd stick to the quality. I'd stick to defensive structures, meaning 3% plus with some calls, so you get a little bit of a kick to maturity. And just keep in mind that people are inquiring here about municipals, and these are wealthy, smart people who have been speaking to me. And thanks.
Thanks, Brad. Some excellent points by Brad, seeing some interest on the street in municipals, and that could be also some people getting ahead of rebalancing. Come January, we may see significant rebalancing take place after the big run-up in the equity markets, and that could have a meaningful effect on the overall market as some of the money comes out of the equity market just to rebalance. That's everything I got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.